Nvidia lends other companies the money to buy Nvidia chips. That is not a rumor. It is the reported structure of deals worth over $500 billion. Critics call it circular financing. Nvidia's chief executive calls that idea preposterous. Both can be true. So here is the question. Is the money going in a circle? And does that matter? Here is the shape. Nvidia sells the chips AI runs on. Its customers need enormous sums to buy them. So Nvidia invests in those customers or guarantees their leases or arranges their financing. They spend much of it on chips. The money goes back to Nvidia as revenue. Money out, revenue in. Same company at both ends. There is an old name for this. Vendor financing. Remember it. The reported numbers are not small. Bloomberg reported Nvidia weighing a guarantee of up to $250 billion on data center leases for OpenAI, plus $350 billion to finance chip purchases. Separately, Nvidia and 6 of the largest asset managers announced an effort to mobilize over $500 billion for AI infrastructure. Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs, KKR. That is bigger than most countries' budgets. Here is one deal you can read yourself. CoreWeave rents out AI computing. Nvidia sells it the chips. Nvidia also owns a piece of the company. And Nvidia agreed to buy CoreWeave's unsold capacity if nobody else does. $6.3 billion running through 2032. That agreement was signed in 2023. The public only learned of it from a securities filing in October 2025. So Nvidia is the seller, the investor, and the buyer of last resort. 3 seats, 1 table. Now, the other side, Nvidia rejects the circular label. Its chief executive, Jensen Huang, says the capital Nvidia provides is only a portion of what these companies must raise. He called the idea preposterous, and he has a point. Investing in your customers is legal. It is common. Every large supplier does it. Nobody here has been charged with anything. Nothing in this video is a crime. Hold that thought. So test it against the last time this ran at scale, 1999. The telecom boom. Equipment makers began lending customers the money to buy their equipment. Lucent committed $8.1 billion. Nortel, $3.1. Cisco, $2.4. Their own filings say so. And it worked. Revenue climbed. The order books looked spectacular. Every analyst agreed the demand was real. Here is the detail that should stop you. Those vendor loans did not peak during the boom. They peaked after the crash began. When customers ran out of money, the lending went up, not down, up. Stopping meant admitting out loud that the orders would never be paid for. The financing did not cushion the fall. It extended the bubble. Then the bill arrived. Lucent wrote off $3.5 billion of customer loans. Revenue fell from $37.9 billion to $11.8. It never recovered. The crown jewel of American telecom was broken up and sold for parts. The equipment had been real. The customers had been real. The demand was not billion. But be fair, 2 things are genuinely different now. The carriers of 1999 were startups with almost no revenue. Several of Nvidia's largest customers are the most profitable companies in history, paying cash. And the chips are being used today by hundreds of millions of people. That is a real business. The question was never whether demand exists. It is. How much of it is paid for with money that started at the seller? There is a second argument, and it is about accounting. The investor, Michael Burry, says the big cloud companies write down AI hardware over 5 or 6 years, when the useful life may be closer to 3. Stretch the life, and today's profits look bigger. He estimates $176 billion of understated depreciation between 2026 and 2028. He called it one of the more common frauds of the modern era. The company disagree. If a chip still earns for 6 years, just not at the frontier, the accounting holds. Again, nobody has been charged. It is not only short sellers asking. The Bank for International Settlements warned this year that AI spending is increasingly financed with debt. S&P Global projects AI data center debt climbing from $57 billion to $215 billion by 2028. A survey of fund managers named AI spending the most likely trigger for the next credit event, and United States senators asked the government to investigate how big technology borrows in opaque private markets. 4 sets of adults, 1 room. So run the arithmetic. To justify this much building, the AI industry has to earn it back. Sequoia's David Kahn put the figure at $600 billion a year. Big technology spent about $410 billion on capacity in 2025 and has planned roughly $725 billion for 2026. Revenue is growing. It is just growing slower than the spending. That gap is the number to watch. In June, Bloomberg reported the sales are finally starting to catch up. But in 2001, at the peak of telecom, the same gap was 32%. Today, it is about 46%. Now, one more thing about the paper. Some of this debt does not sit on the technology company's books at all. Meta's largest data center is financed through a separate company backed by $27.3 billion of bonds that mature in 2049. Blue Owl owns 80% of it. Meta owns 20%. S&P said it will not count that debt as Meta's. Meta pays a higher interest rate for the privilege, roughly $270 million a year, to keep it off the page. So here is the pattern. When a seller finances its own buyers, revenue stops being a measurement and becomes a decision. That is not fraud. It is not illegal. No one here has been charged with a crime. This is not investment advice. It is one question, and it is the same one that mattered in 1999, not whether the technology is real. It was real then too. The question is, who is holding the paper when the buying stops? Last time that took 18 months to answer. This file stays open. Subscribe.